5 minutes to trickle in. Let's get started. My name is Aaron Newton. I'm Chief Data Officer here at Thanx, and I've been having a lot of conversation with restaurants across the industry about the impact on restaurant margins that the third-party platforms have had for many years. But recently, it's taken a slightly different tone with the introduction of the advertising platforms that these marketplaces have introduced. I'm joined today by three very thoughtful leaders in the space who have been thinking about this problem for quite a while with me. And we're going to have a conversation about what that means to their businesses and to others in the space, to the industry in general. Joining us from Sweetfin is their president, Seth Cohen. Say hi, Seth.
Hello. Oh. Sorry. Hey, guys.
Seth, why don't you really quickly just tell us in a sentence or two what Sweetfin is for those who maybe haven't been there?
Sure. So we are a fast casual premium poke concept based in LA. We have 16 units across Los Angeles, Orange County, and San Diego. And our mission is to fuel life through freshness.
Love it. I'm also joined by Chris Ives. He's the CFO over at Bubbakoo's Burritos. He herds a lot of cats at a lot of different burrito shops across the Northeast, I believe. Chris, say hi and tell us a little bit about Bubbakoo's.
Yeah, thanks, Aaron. Thanks for having us. Yeah, so Bubbakoo's Burritos is a fast casual 130 unit burrito chain, primarily in the Northeast, but we have locations in the Southeast and the Midwest. But, you know, we're a Mexican fusion burrito shop. Been doing it since 08, so it's been a unique, long 17 years of highs and lows of the restaurant industry, to say the least.
And then finally, we're joined by Patrick Berry over at And Pizza, their SVP of Marketing. Say hi, Patrick, and tell us a little bit about And Pizza and yourself.
Yeah, thanks, Aaron. Hello, everyone. And Pizza is an anti-establishment establishment. We love making a fuss, and we don't sway away from calling it as it is. We are a 55 location, mainly privately owned fast casual pizza company. And we are mainly in DC, Baltimore. We've got locations in New Jersey and Philly.
I'm also joined by Alexa Detzi, Thanx's VP of Customer Success. Say hi, Alexa.
Hi, everyone. Excited for the convo.
Alexa and I both spend a lot of time talking to restaurants. I'm going to run through kind of an agenda. Our goal today is to share. Well, I apologize. That first goal is from the prior version of this slide from our webinar a week ago about our product. I'm going to do this on the fly. Our goal today is to talk about margins at restaurants and the impact of third parties and their changes with advertising. If you have questions, you can use the chat feature over on the right, and we'll do some Q&A at the end. If you want to follow up, you can email CDO at Thanx.com, and the data team that I run will field those or reroute them to where they are most appropriate. Okay, so the agenda. I'm going to quickly run through kind of how we got here. I'm actually assuming that most of the people on this call have a pretty good understanding of how we got to where we are, but maybe not a shared one. And so I'm going to quickly run through kind of what does it mean for the third-party platforms to introduce this new advertising story, and why, and what is happening there, what are their CEOs talking about, and so on. Then we're going to dive in and talk a little bit about the math of the, how to understand your margins in a world where it gets way more complicated when there's all these different promotional aspects of it. Digital strategy to balance both first party and third party. Patrick's going to lead us a little bit on that. We're going to be talking about, I skipped a bullet there, how Uber and DoorDash are seeding this marketplace to kind of jumpstart the dependency for everyone to be participating in it because it's profitable for them. And then finally, we're going to walk through a playbook for success that Alexa is going to lead us through, which is what do you do about this? What strategy do you need to adopt given this knowledge? And then if we have time, we'll do some Q&A. All right, so really quickly setting the table. Restaurant margins, this is from a study by Aaron Allen last year. As all of you know, restaurant margins are a very challenging beast. Restaurants are expected to be profitable on day one, and pretty much as long as you're selling the food for more than it costs you to make it, then your business should be. And yet, it has been a very challenging year or two with inflationary economics and labor market changes and so on for restaurants to stay on the top side of this graph. The investment market values the top line revenue of restaurants greatly. If your year over year same store gross sales are higher, the industry refers to this as our comps are up. Historically, the private equity and other investment people out there tend to value that very highly. This was a shortcut to understanding the health of the restaurant because of that need for brands to be profitable on day one. The assumption was always that you were selling the food for more than it cost for you to make it. In the before times, it meant that whatever your total costs were, you had some small amount of profit and all of your revenue fit into this story. With the introduction of third parties, they introduced a lot of commissions and fees that made this a harder story. When you combine your first party revenue and your third party revenue, you end up with a potential negative situation where the business no longer remains profitable. The response to this, shortly after the third party platforms were introduced and gained market share as they became more and more revenue for the business, especially during COVID, was for restaurants to raise the prices on the third-party platforms. This made them more expensive than ordering direct, which was by design for most of the restaurants who executed this strategy. But it right-sized the business so that once again, if same-store sales and gross were up year over year, that the business was healthy and growing. However, this is not necessarily working for the third-party platforms. The actual business of delivering food is very difficult to make profitable. When a third-party platform delivers an actual order for a consumer, they tend to make something like 2.5% in revenue off of that. The only way to build a very successful business that scales with that kind of margin is to have a massive amount of market share, which these brands have mostly achieved, and yet profitability is still somewhat elusive for them. So what do marketplaces do as part of their natural progression to becoming a profitable environment? When they own the consumer who's buying the product, they add advertising. This is a playbook that has existed in every marketplace. If you go look at Amazon, for example, their advertising platform is now a $38 billion annual business. It's larger than X, YouTube, and Snap all combined. Where when they deliver something to your house for next to nothing, they can subsidize everything going on in the marketplace through these advertising fees, which allows them to keep the prices low for consumers, which ensures that the marketplace remains large, which feeds the advertising business. Walmart has done the same thing. Here's a quote from their CEO talking about when you have all the people buying things inside of your marketplace, it's an opportunity to sell advertisements. And you can use the revenue generated by advertising to keep prices in a good range for consumers. The golden goose here is that marketplace. So big audience means you can move into a pay-to-play mode, and a higher margin on advertising can help you lower the overall cost for the consumer. This aligns the marketplace and the consumer's interests against the producer's interest. So here's Uber talking about merchant-funded offers are helping restaurants drive demand. And it helps address, quote, the affordability question that folks are asking. They're asking Uber about the affordability of their marketplace, given that restaurants have increased their margin. Here's DoorDash saying the same thing. It helps us maintain affordability for the service. That makes it easy for us from an ad perspective. I think the size of this business would be an impressive standalone company. These massive marketplaces are designed to extract as much value from the production side of the equation and split it between the consumer and the marketplace runner. Here's what that looks like. This is from a study we've done with a couple of brands, looking at the marketing promo advertisements they've run on DoorDash. When a check comes in, 100% of it is the whole bar. The first thing that comes off is the commission, 17, 18, 20%, something like that. That's the yellow on the right. The next thing that happens is the consumer gets a discount. That's the orange. But in addition to that, the marketplace extracts a promo fee for the privilege of having delivered the discount to the consumer. This is all margin. And the third parties use flimsy math here to say that the ROI of that red bar is the whole bar, as if the discount and the commission didn't even happen. Yet when you actually do the math, you can see the bottom bar is the total of all of the ones above it. 52% of the revenue goes to the restaurant. That's a 48% commission on promo-oriented offers that is highly profitable to both the consumer and the marketplace. The reality is that restaurants don't have an affordability problem. Uber and DoorDash have an affordability problem. And historically, they've borrowed from Wall Street in order to create enough value to make the marketplace grow. And that is coming to an end. Who they're taking it from now is the restaurant. So that's how we got here. That's where we are. So now we're going to stop slide time and we're just going to talk about it. So I'm joined by Seth over at Sweetfin. You can see a little bit about what their concept is like. I'm joined by Chris Ives, CFO over at Bubbakoo's. Again, fantastic burrito, tacos, etc. And then we have Ann Pizza. They have been reinventing the pizza space from both technology and food quite some time. So I'm going to stop showing my screen for the moment. And I'm going to kick the first question over to Seth. Seth, you have a storied journey with the third-party platforms. And I'm curious if you can share a little bit about that journey, starting with Postmates, all the way over to what it means for you to be exclusive with Uber.
Sure, we've definitely rode the wave of third party from its inception. I think we, as a company, were the first ever exclusive partnership to ever go on a third party, and that was back in 2016 with Postmates. And the idea back then was there were all of these different platforms in the marketplace that were doing the same thing. They're all delivering food. And the idea from the third parties were, how can we get the best content or the best brands or best merchants on platforms in order to distinguish ourselves from the consumer to the consumer? And so we were pitched on this idea from Postmates that they have control of the market in LA, and that's where we were primarily at the time, and that they could guarantee a certain amount of revenue in order to make sure that us being on their platform would create a beneficial success for us. And there was a whole lot of different marketing initiatives around our launch on Postmates. So we went exclusive on Postmates, and they basically took the model of Sweetfin and then they started to roll it out into other exclusive models, and other third-party platforms like DoorDash, Grubhub, and Uber, of course, followed. We spent 3 years exclusive on Postmates. It worked out really well. We took advantage of a lot of their marketing initiatives, and we were growing alongside them as they were building market share. And then Uber went ahead and acquired Postmates. And what was interesting about that acquisition was that if you look at the investor deck that went to the board in order to get the acquisition approved, it talked about the acquisition not necessarily of Postmates, but the acquisition of these hero brands in Los Angeles that they were having access to. So Sugarfish, Sweetfin, Tokaya, and some others. There's 5 or 6 that were listed. And so really what we started to realize was that the incentive of the third party was not necessarily to help us as merchants, but in order to gain our customer and to get our customer to utilize their platform. We then, through the acquisition of Postmates via Uber, were exclusive with Uber for a few years, and then decided, due to the market conditions, that perhaps we shouldn't be exclusive anymore. So we went off exclusivity, added DoorDash, added Grubhub, and wanted to see what would happen. And our thought would be that you would have all of this incremental revenue by going to the other platforms. And in the market that we're in, Los Angeles, again, in Southern California, Uber and Postmates, for whatever reason, seems to have a stranglehold on the market in terms of revenue. But we did think we'd probably see a 30 to 40% increase in third-party sales by going to the other platforms. And really, we didn't see that. It was just the sales that were leaving Uber were going to DoorDash and vice versa with Grubhub. What we also saw, which was interesting, was coincidentally with the our transition over to the other platforms, you started to have the proliferation of the other businesses that the third parties were now pushing, which was the marketing, cost per click, CPMs, all the different ad initiatives that they're having on their platform. And so what we started to notice was our costs of being on those platforms started to get completely out of whack once we started to factor in all of the different marketing and promo fees that they wanted us to be a part of. And so we actually made the challenging decision a few months ago to go back exclusive on Uber, A, because we weren't seeing a lot of revenue growth, but B, in terms of our P&L from a margin standpoint, it was really the best outcome for us to maintain the four-wall margins that we needed in order to do so. So that's kind of the history of where Sweetfin is in terms of third party.
Can you talk a little bit about the dynamic you hinted at there about the advertising across all three of them really started to hurt your margins? Did that dynamic change when you went back to being exclusive to Uber? Or was it really just easier to manage because there was only one place for you to do it?
It's a combination of both. Number one, it is easier to manage. You do have a little bit more of a, company to company relationship where you're having a weekly dialogue and going through expenses and making sure that you're managing costs. The other benefit to being exclusive, and I'm not saying that exclusivity is the right way to go for brands, I think it just honestly depends on the area in which you're operating in, is that there are a lot of incentives and credits that they're providing in order to offset some of the costs in terms of all the ad platform costs that you're seeing. I think for us, we were in a situation before going non-exclusive that we had this revenue guarantee, and the revenue guarantee allowed Uber to essentially run promotions on our behalf without us being able to stop them. And so we went from a period of almost 4 or 5 years where promotions were being, run for us to us having to manage those promotions for ourselves. And so we never really understood the costs associated with running certain promotions, not only, the basic promotions like spend 30, get 5 and those sort of things, but the new ad model that they built where if you want to be seen, basically the platforms are digital real estate. If you want to be found on the platforms, you need to spend. And now they were also trying to get us to spend across competitors, right? So if someone searched sushi or someone searched salad, you would find Sweetfin. And so we were also getting a lot of mixed information because we get these weekly reports from our team, from both DoorDash and Uber, with these crazy ROAS numbers, 9, 10, up to sometimes 19 times ROAS. And it didn't make sense to us because our sales were essentially the same. Yeah. So we were spending to get sales that were not incremental. And the data that they were providing was disingenuous, to say the least.
Chris, this maybe would be a good moment to segue over to your experience. As a CFO running a franchise organization, you are herding a lot of cats. It's harder to just make one decision and have it just happen. And so hearing Seth struggle with it where he does have that kind of control, I imagine it's even worse for you. But maybe you could talk a little bit about what it means as a financial officer in this situation to try to actually quantify what Seth is intuiting. I'm spending a lot more on advertising, but my top line hasn't moved. You have a slightly harder burden, which is that you have to go prove that at the franchisee level. And what's worse is that even if you are spending a bunch of money and top line hasn't moved, if you stop spending the money, top line moves, it goes down. What has that conversation been like for you at the franchise level?
Yeah, to be honest with you, it's been 12 months, maybe 18 months of literally living and breathing the data of DoorDash and Uber. Just to give some background, I'd probably say, I think it was last July, we were shadow banned by DoorDash. And that's really when we sort of, buckled down and said, hey, we got to figure this out. Historically, our model has always been we mark up, we cover, we bring back what it would cost a guest to, operate in our store. It wasn't more expensive. It wasn't cheaper. That's always been our model. Last year, when we saw this massive drop in sales, during a busy, burrito season, we just said, what is going on? And we basically saw that, they changed their algorithms that, if you're marked up, we couldn't be found anywhere, whether it was on the front page or, within the Mexican category. That pretty much, put us into full, 911 mode where we were trying to figure out that, recapture, that sales, just because it literally vanished within a week. But really from there, where I'm going with that is we basically provide a model to franchisees for the most part, to give them a good understanding of where they need to be to get them back to in-store to remain profitable and not really to absorb any margin within the P&L. There are some folks that have different goals, or owners would say have different goals that want to go after marketing, which is okay. I think new guest acquisition is a metric that is probably highly valued by some operators. And if that's a quarter or a month or a week plan, we support it, but we just want to educate and really break down to a daily, weekly P&L, with this, I don't know, I was mentioning this to Aaron a couple months ago. This expense line item doesn't seem to exist anywhere within unit level economics, P&Ls across the industry. The past 2 years, I've spoken to enterprise, down to, mom and pops. And it just seems like this expense of commissions and marketing is sort of just a plug number within people's P&Ls. So it's really getting, in our case, franchise, partners to really understand, what's going on at their unit level, when they're advocating to do more marketing or when they're concerned about, oh, my sales dropped in Uber or my sales dropped on DoorDash. Forget about the marketing piece. There's also the chargeback piece. That's a whole nother element to the economics of what goes on. And if you don't have a handle on that, or if you're not even looking at that in a business where, to what Aaron alluded to before, labor margins continue to erode, our EBITDA, it's every penny is critical on these 3 Ps. So we don't have the ability to go exclusive just because, we're in certain markets where, one's more prominent over the other. But all I could say is, we continue to educate at the corporate level. We do own corporate stores. We do run certain initiatives weekly, daily, just to sort of test, and I'll fast forward to, I think it was August of this year, DoorDash, I don't know if it's public or not or what it is, but we saw our sales totally vanish again. It wasn't due to a markup. It's now due to the price parity that they're after. So, we've been a partner since 2016. I feel like we helped, contribute to what they were looking to do. And then we basically got the rug pulled underneath us because now it's not about spending money on ads. It's now we got to be the cheapest to consumer, which continues to even erode the, the margin even further. So now it's sort of like the crosswinds of, you wanted us to spend marketing, we spend marketing. Now it's like, okay, we don't really care if you spend marketing. We want you to be as cheap, 0% price parity, which it's just not physically possible to even do in today's world. So, we're continuing to test if advertising and dropping the markup works. To be honest with you, we haven't seen a difference. So, we sort of have different plans of what we're looking to do. And it just every day on top of dealing with the daily headwinds we deal with, now we're worried about third-party customers and getting a cheaper product than what we offer in the store. And at some point, it just, you start to wonder, say, where's the government going to step in and start to help us here? Because, we continue to, to what you said before, they're coming after the restaurants now in some form or fashion.
Patrick, I see you nodding so vigorously with everything both Seth and Chris have said. And so I'm curious, like, what is your reaction? I see you have one. I want to know what's going on in there.
Yeah, I mean, I don't wish these were isolated stories for Chris and Seth's sake, but they just aren't. Like we deal with this, everything from, seeing sales drop off and then trying to make a change. And then, the way that the reporting works, the way that that you're really forced to like try and only focus on all customers, which means that their, you know, quote unquote ROAS is going to be higher, but that's because there's so much organic sales that they're just getting to tag by saying I showed an impression when we probably would have got that sale anyway. But it's so muddied by the way that the reporting looks that, like, you know, I'm a computer science guy. I've got an advertising background. Like I know media buying, whereas I can see a lot of companies are going to, like, you know, show their CFO and the CEO, hey, we got a 15x ROAS, and everybody feels good about it. But to your point, like we start spending more, but you know, our actual sales from third party aren't really moving at that same level, and it just doesn't make a lot of sense. But then, you know, when you want to make an adjustment to either lower cost or try and ramp sales for like strategic operations purposes, you never see it, or if you see it, it's going to be 2 weeks later. And you know, basically the answer is you got to give it a little bit of time. And you know, for the type of work that we're trying to do, trying to solve sales problems for specific shops, you start realizing that you can't rely on them for that. But they do possess the captive audience whose stomachs are growling, that you're fighting to try and get those, you know, pizza sales and lunch and dinner sales. And so it's you know, it seems like it would be the best solution, but a lot of times it isn't.
I'm hearing a couple of themes here, which I alluded to earlier, but you each have kind of told in your own voice. One is that the platform has an affordability problem, and it is exerting as much pressure on restaurants as possible to make it the cheapest option. Their clear goal is that consumers would prefer to order on those platforms because it is the most affordable way to get the food. And I'd love each of you to share like your own strategy or thoughts about what it means for you to subsidize those platforms that way. Maybe that's a little too open-ended. Chris, you shared something really interesting with me a while ago about how this money flows into the point of sale, which I just heard Patrick kind of allude to, that it's really hard. There's some math that you kind of illustrated for me a while ago, where the same exact purchase with the same exact discount on a first-party channel versus a third-party channel looks better on your point of sale for the third-party order than it does the first-party order. But then 2 weeks later, you figure out that it actually was far worse. And what has it meant for you to try to bring this mentality to your franchisees who just look at their point of sale numbers and say, hey, sales are great?
Yeah, this is, you know, again, I think everyone's tech deck is probably different. I don't know. I've been shouting from the rooftop for the past year, maybe 2 years, you know, how does the commissions and the marketing not flow into the POS through the APIs? We use Olo into Revel POS. So, you know, operators are focused on, you know, serving good product, taking care of their guests, making sure everybody's happy, making sure that, you know, the order accuracy is right. On top of that, now they're dealt with, you know, understanding P&Ls that, you know, you have to pretty much do on an Excel sheet, or maybe you have a BI tool that allows you to really understand your true cost, you know, whether it's daily or weekly or a monthly snapshot. So again, I think this even adds more added pressure to the everyday operator just trying to, you know, make their guests happy and serving awesome food. You know, they have to worry about, you know, how many ads came through that I'm not seeing that might have cost me $5 to, you know, to make this one burrito. So again, it just comes down to, you know, from a franchise standpoint, we constantly try to provide tools and educate on what's going on in the marketplace. But it's really, you know, now knowing your new break-even point of what you need to sell with a 20 or 30%, you know, markup, you know, from a sales revenue standpoint.
You used a phrase with me in a conversation earlier this week, healthy revenue. And that implies that there's some revenue that's not healthy, and that's okay. You can have beer with your dinner and drink responsibly, but now you're talking about how hard it is for an operator to figure out that right balance between the two.
Yeah, I guess, you know, we all talk about transactions, right? So the people, you know, the folks, the operators that really want to get sales and you know, they want to see the needle move. You know, when they call and pick up the phone and say, hey, I want to run a BOGO on DoorDash or Uber, and I'm just like, I got to stop and think for a second. Okay, well, when's the last time we've tried to, you know, focus on our guests that come through our first party that we actually know and actually know their value of what they're spending in their store? Why do you just want to turn on the easy button or feed the drug of just turning on advertising? Well, they've created a product that is so lovely, beautiful, whatever you want to call, whatever adjective you want to call. It makes it so easy, and then it's instantaneously. You typically see success on it. Are you actually making money on that? Is it actually paying the bills? Is it covering your costs? It's the hard question to have, but it's trying to get our operators to really understand. Okay, you want to focus and spend money, on a third party, but what are we doing on our first party to actually go after our loyal guests? Because we have no information on any of these guests, as we all know.
So open question for this group. When you think about what it means to engage with this new dynamic with the third parties, where the margin value of a purchase is so challenged because the third parties want you to fight for every single transaction. What are the strategies that you're putting into place to start fighting for the customer? And Patrick, I know you've put a lot of thought into this, and Seth, I know you're trying a lot of things too. I'd love to hear from each of you actually about like what it is that you're starting to do now that you've kind of diagnosed the issue. Patrick, why don't
I'll
you
go first if that's all right. Yeah.
Yeah.
So it's a really challenging problem. It excites me because it's a challenging problem that when you get it right, it's gonna really increase the health of your business. But it's a tough one, right? So we talk about people with the phones in their hands and their stomachs grumbling. They're fishing a barrel, and you got a shotgun, and you can get that sale, but you're buying an order. You're not buying a customer. And so out of the pandemic, our story is maybe a little different. But over the last 12 months, we had a major leadership change. We brought in a new CEO who was very ops centered. And so we have spent the last 12 months bringing in a new operations team, which really focused on addressing operational issues in our shops, to which our now focus. I mean, previous to that, I was nervous to do first party marketing campaigns because I didn't want to spend money and actually, ruin the brand by someone not having a great experience. And when you're pushing people to third party, it's an understandable lower expectation as a customer. Like I ordered through DoorDash. I don't know, was it DoorDash's fault? Was it somebody's fault? Whatever, if it came cold. If we took 10 minutes to give that dasher a pie, the customer's really not going to know the difference. But now that we feel very strongly that a lot of the operational issues have been fixed, we're very proud to be pushing people into our shops where we have the best experience. So, I mean, the simple version of it is, wean off the spend, only spend where it makes the most sense, starting with like a free delivery promotion, because you're talking to people that have the lowest commission rate, and it just always works, and that doesn't cost a lot of money. And then looking, stack ranking by a shop basis, which ones work the best, and then start testing, more first party initiatives, so that you don't crater your sales for those shops, but you're also, doing that really difficult thing, which is customer acquisition, not with somebody with a app on their phone, who's hungry, but try and convert them to first party loyalty members. But when you do that, their fake ROAS doesn't matter to me. But if I can get a CAC for a customer for $25 or $15 compared to a cost per order of $6 on any of these third parties, I'll take that all day long. Because that's a lifetime. I can bend that frequency curve. I can instigate a higher AOV for that customer. I can track my lifetime value for that customer. The others, I'm just buying again and again at that really unhealthy revenue.
the customer LTV versus transaction ROAS that is flimsy and not believable? Seth, I'm curious if you can share some of your experiments and thoughts on the strategy you've started to execute having diagnosed this issue.
Yeah, I think going back to the issue, something that we didn't really cover was, the affordability issue. We of course talked about the menu inflation and how the third parties are asking us to bring down our menu inflation in order to be more affordable. But the other thing that they're doing is they're convincing everyone on the platform that they need to discount. So everyone discounting. And so if you're not discounting and you hold your ground, then you are no longer competitive on the platform. So I think it almost is going to take a group effort amongst all restaurants or certain types of restaurants to stop discounting, or at least try to wean off the discounts as much as possible, because the third parties are even incentivizing financially. Hey, you want to do a BOGO? We're happy to pay for 50% of that. So it's very challenging, even if you have your menu inflation at 0, which is not realistic, to compete against a competitor if they're running a buy one get one or a 50% off 30.
Which maybe they aren't even paying for, right? Because the third party might be paying for
Exactly.
theirs, not for yours. So it's a game of musical chairs about who's being funded, but what they're really doing is training the consumer to expect a discount on every order.
That's 100% right. So you have discount. So you have consumers that are going to the platforms that feel that ordering on those platforms is actually more economically advantageous to them rather than ordering direct. And so, there aren't too many ways that we've come up with to combat that other than just to fight fire with fire. And it does create a little bit of a contentious relationship. But for example, something we do is we have collateral, and this isn't, groundbreaking stuff that we're doing, but collateral that goes on every single third-party bag that gives a breakdown of costs and explains to the customer, hey, you could have saved 30 to 40% by ordering direct. We also have a strong intro offer to get people to go on loyalty. So scan the QR code and you'll get $5 off your next order. All of our messaging when we're having issues with guests on third party is moving them over to first party. Hey, even if it's expensive, we're happy to give you a $20 credit on your next order. This is how you order direct. Oh, I didn't even know you guys you had delivery, is typically what customers say. I think utilizing the tools that Thanx has, not to, necessarily promote Thanx or any of the loyalty platforms, is really creating the automated campaigns in order to get the behavior that you wanted, to get those engaged customers ordering on a weekly or bi-monthly basis, are super important. We're thinking about running tests at certain locations where we have free delivery if you're a rewards member above a certain dollar amount. So if you spend $30, we'll give you free delivery. Even that is more affordable for us. Just using the tools in our arsenal, I think, is super, is the best way to fight the third parties. And then something that you and I have kind of talked about is always ensuring that is less expensive to order direct than it is to order on third party. Like, there should be no reason in no world and no promotion that if you go on Uber, Postmates, or DoorDash, that someone is getting a better deal than if they're ordering first party. I think that is, a rule that everyone should set.
I want to get to, I feel like this is a good transition moment to kind of, we have kind of like a playbook that we put together that candidly is based on much of the feedback we've heard from this group and others that we've spoken to. So I'm going to bring Alexa on, and I'm going to go back into slide mode a little bit. So Alexa's going to lead us through a playbook for how do you actually right size these margins. And I think that each of our guests today are running pieces of this, if not all of it, right now. And so it's worth noting that 6, 8, 9 months ago, it wasn't as important to be so laser focused on how do I get my margins square, because you'd sort of right size them by just raising prices. And now you have all this pressure from the third parties to eliminate that gap, and that every single purchase needs to be discounted if you want to get any sales at all. And all of that means that now it actually is mission critical that you compete for the customer more than the transaction, because when you compete for the transaction, you lose so much margin, half of it. So Alexa, why don't you take us through the things that your team here at Thanx have kind of put together from all of these conversations?
Sure. Thanks, Aaron. As Aaron mentioned, we were hearing this come up a lot, and what we've realized is we need to help our customers and also those in the industry understand how to close the gap a little bit more tactically on the 6 key areas that we think are crucial to success. And so our goal with this is to really help folks understand a little bit more about their business, but also have a fighting chance in an increasingly competitive environment. And so I'm going to give a quick overview of these, and then we'll dive in and I'll ask some more pointed questions to our panelists. And so when we think about solving this, the first step is to really do the math and compute the margins. And so, Chris, we talked a little bit about this as a place where you started, and I'm curious if you're able to talk to us about how you approach this overall. I'm specifically interested to hear if there's any special places you had to go to find the data. It's been a bit convoluted from what I've been able to see. And if there are any things, any tips and tricks that you have for others that are looking here that are maybe not so obvious that they should go look at in any reporting.
It's more for us, at least, it's more of just educating the operator. Again, everyone's very busy in today's world, and think about third party, on the calculation of, I got the cash, okay, I'm happy. But it's more so on a monthly basis, at least going to the invoices to at least say, hey, did I lose money on the platform or did I make money? Just at a high level, I think if we're not doing that today, that's a problem. We try to train weekly to sort of run the P&Ls of this when you're doing your flash reports. So again, I think it's as simple as just educating and knowing where to go from the statement standpoint. I think some of these platforms get a little creative and hide some of the data, and they make it a little harder just to sort of, I don't want to say scare or overwhelm, maybe just a more hands-on operator. I just think that plays into the mind games of what they like to do. But again, it's as critical as knowing your goal, knowing your strategy, and executing on it and baselining it to see if it's working or not. And then really, again, on a weekly, monthly basis, knowing if you're making money on the platform is critical.
Great, thanks. Let's jump to the next one, Aaron. And so our second kind of key to success here is to help to give your team a mission. And so this is kind of carrying forward what Chris just said, making sure that you're getting everybody involved in understanding what the implications of this. But one of the maxims that we talk about here is like not letting your third party grow faster than your first party. And so that breaks down to measuring each store's ratio, but also making sure that we're avoiding any of that ad and promo spending that we just talked about for a little bit. And so, Seth, you mentioned a couple strategies that you're doing kind of in store. I'm curious if there's anything else that you're thinking about from future state or even like things you would dream up that you wish you could do from a technology standpoint, and then how you would think about measuring the efficacy of those.
I mean, there's 2 ways. There's analog and digital here. On an analog side, it's really being laser focused and explaining the importance of first party to our team members and making sure they're educated on understanding how the platform works and why it's important and why they should be selling it. I feel that it's almost more important to upsell our app and website for digital orders than it is to upsell a drink or a side of chips. Every single cashier during every single transaction should be handing a guest a piece of collateral that talks about our loyalty program and the benefits of being on the loyalty program, and making sure that those team members are trained and are effective communicators on the benefit of the loyalty program is really important. So that's the analog side. On the digital side, how can we take some of the spend that we're spending on third party and pump that into geo-targeted ads that have a swipe up link and promote loyalty as well. So you have really great creative and content, and you have a swipe up to order. Here's $10 off your first order. Again, that may seem like a very aggressive promotion. However, the customer acquisition costs, if you can really get them within the flywheel of your campaigns and get them to be someone who is consistently ordering, it's a lot cheaper than acquiring that customer on third party when you have no ability to communicate with them. So I think a lot of our advertising spend needs to, at least what we're doing, is linking back to that sign up page, and that's an easy way for us to track with actually the unique sign up links that Thanx creates, so you can set up one for different campaigns and territories. That's a great way for us to track if that's working or not.
Great, Thank you. That's a really good segue into the next topic, which is a bit of a meatier one, and I'm going to direct this one at Patrick. And so here, the kind of key to importance is creating this 5-star differentiated first-party experience. And you'll see that this slide has the most bullets underneath it because it is a really big body of work. And so there's a few areas that we think about what that first-party experience looks like. It's obviously app and web being competitive to what guests are experiencing on those third-party apps, which in and of itself is a huge amount of work. There needs to be attribute clicks back to all of those advertising, which Seth, you just mentioned. We need to give consumers a reason to order direct. And so education's a part of that, but also, a promotion strategy or any benefits that they get for directly ordering. And then making sure that you really understand who your customers are and that you can retarget them. And so, Patrick, I know you've been spending a lot of time on this with Pizza, and you've also transitioned from like a build to a buy model, and are now using a more white label product, which happens to be Thanx. So thank you for that. But as most restaurants don't have a budget to kind of build everything from scratch, can you break down kind of how you think about a 5-star differentiated experience if you don't own your UX, or some important things for others to get started on?
Yeah. So 6 years ago, we left Level Up and decided that we wanted to build. That sounded like a great idea at the time, and we built a bit of a Ferrari, which allowed us to have full customization to anything we wanted to do. If we wanted to have certain colors, we wanted to have our KDS work a certain way. If we wanted the app to have a certain modal, like whatever we wanted to do, we could do. But with that came a lot of cost, like actual cost and time and energy that, when we're dealing with all of the APIs, both for the third-party marketplaces to flow in through our order aggregation that was custom and developed by ourselves, but also, dealing with Uber Direct, DoorDash Drive, and, Relay and things like that. Like, there's a huge amount of technical lift that was fun to work on, to be honest. Like, it's really cool, but we found ourselves, especially through the pandemic, I'm not blaming it, but like, we all of a sudden we've got all of this technical debt that's cool and awesome to work on, but every time that Grubhub changes their API, like we have to deal with that. Apple Pay changes the way it works, like we have to know about it, and then we have to pay to do it. That was all with a client of one. So back when it was done, I think that there was some pretty big holes as to the way that the technology that was out there for restaurants to use. And so we figured we would build that. But now as a client of one this past year, we realized like, hey, we don't want to be a technology company that happens to sell pizza. We want to be a pizza company that leverages technology. So that's where we rebuilt our tech stack from the ground up with the right partners that simplified it, closed the loop on the not having to have all of these wild integrations with loyalty and POS and KDS and ordering platforms. So moving to like, I love Thanx. I'm on this thing. I'm not saying everybody has to, but you need to find a partner that will automate as much of this as possible. With that does come some concessions, right? Like, I'm annoying Thanx on a daily basis. I think they're probably going to take the feature request away from me because I'm just hammering them with things that I think personally would work great for us in terms of like click attribution and order attribution. But like, you have to find the right partner that makes sense for your business, and then utilize their tools, right? So everything, Seth, you are exactly right on the money with everything that we're doing, which is focus on that in-shop experience so that we flip those customers that we somehow got into our shop. But like, our percentage for known visible users in shop, as easy as it makes Thanx makes it for the credit card swipe, like, it's too low. It'll never be 100%, but it's too low. And you're absolutely right. I'd rather have them get a loyalty member in than pitch a cookie, And so the things that we're doing is utilizing all the data that our partnership with Thanx allows us, is to have our shops be able to have a dashboard that shows the number of new users that come in. We can have contests. We can have shop leader and district leader bonuses based on the growth of those numbers. And not just for them to have like personal stats, but also realize like they're building their business. Like, you don't hope that person comes back in. I'm sitting here, the wizard behind the curtain, saying, hey, we got double coin Tuesday, show up, all of that kind of stuff I can do to increase sales for those locations. If I don't get the known user, I can't do much. So
yeah,
I think that answered your question.
And for the record, we love your feedback, and I'll make sure we don't take the butt. Cool. Let's jump to the next one, which we talked about a little bit. So for the sake of time, because there's 2 more that we want to dig into, I might just skip over this, but to highlight it, it's really about a comprehensive pricing and discount strategy. And so this is, again, unpacking, whether customers can get the cheaper value or cheaper price on third party versus first party, and making sure that doesn't happen, but also digging into that affordability problem. And so I think, Chris's focus on education with his team in terms of understanding the numbers and making sure that they really, really own that. Patrick, you gave a little bit of that. And then Seth, for you, is really thinking about what that looks like in store in terms of an experience and how your teams can interact with customers, help them understand the value that they're going to get by ordering direct. And so let's jump one more ahead, Aaron, if you will, please, to our next one, which is around building a 12 to 18-month strategy to help right size your margins and lower that dependency on discounting. And so this is another meaty one, which, Patrick, I'm going to go back to you on this, but we did talk about kind of owning that customer experience. And so don't compete for the transaction, compete for the customer, because they are so much more valuable. And so I'm interested in how you break this down. So you mentioned that you started about 18 months ago, if I remember correctly. And so if you were going to kind of advise a friend to go back and do that again, what would you say from a quarterly basis you would do to help to break this down so that we can get a little bit more tactical and have a fighting chance coming out on the other side?
Yeah, I always talk about, I actually have a great relationship with the third parties, to be honest. I always call them a necessary evil, even to their faces. But there are going to be people who just prefer to use those apps. Like I accept that, right? I'm okay with that. That is an extra part of our business that if they want to continue to go that route, then I just want that percentage of our business to be as small as possible, right? So the tactics that we are doing is just because, again, I keep talking about out of the pandemic, but you hit certain sales levels, and Aaron, you brought it up earlier on, is that you have these certain sales numbers, you've got these certain comp targets that people are focused on, and it's difficult to explain. Yeah, but we're let's say we're down at comp in a shop, but like we're a lot healthier, right? And you could with your overall profitability, but that's not necessarily the norm. So you can't gut it, because then things will tank and all of a sudden your unit level economics don't work anymore. So what we're attempting to do is, take it by, shops, take a cross section of our fleet, and then like methodically and slowly, pull down while we're pulling up. And, with those learnings, continue to like kind of get better every single day by spending a little bit less, capping the number of discounts we have more and more. They always say that the secret sauce is the sponsored listing plus a discount. Like, yeah, that's best for them. Like, at the end of the day, if we are going to lose sales, but we are going to have more of the better sales, like that's still a win. It's just, you just have to have the discipline to kind of, focus on it and realize that, like, as much as I want to like rip the Band-Aid off, you just can't, at least with the way that our business works, and our current setup.
I'll chime into that. If I'll just give a real life example real quick. We did rip the Band-Aid off in a couple of franchise partner stores. We didn't really see that much of a revenue drop, but what we did see was almost a 4 to 5% swing on EBITDA. Again, if you're in that position, everyone's different. There's debt that's got to be paid. I don't know how that impacts the business or not, but I would say don't be afraid to do it. You will, again, the expectation is you will see a drop in top line sales, but in 1 month, we fixed, a franchisee's P&L from, going from, 9-10% almost up to, mid teens on the P&L. So, again, I would support the fact, trial and error a little bit. Don't be scared to do it.
I like that. Thank you. Cool. Just
That's
for
really both of you, that's really powerful thinking, and I appreciate it. That's great. Sorry, go ahead.
Yeah, at the end of the day, when you've got franchisees, like yes, their sales numbers are lower, but they're taking home more. Like they don't even care, right? So that's a really good point.
Yeah. Awesome. I'm going to round this out for the sake of time on this one and kind of pose a question to the audience is kind of how we think about this, which is to use your four walls as a unique differentiator. And so what is the thing that you can leverage that 3PD doesn't own? So that's your people, your in-store experience, and your brand. So lean into your uniqueness here is really a way that we think will be a winning strategy. And then, of course, making sure that you're measuring each of those. That's all we got on the playbook.
So we're at time. I do want to acknowledge there was a Q&A question. Has anyone tracked the ROI on bag stuffers inside 3DP orders and what conversion on that looks like? I'm curious if anyone here has a solid, I have and I know the answer, or is it too hard to measure?
I'll give you one that we did. We literally went on to every single review. We spent a whole week and responded to every single feedback review within Uber and DoorDash for all 100+ stores. I think we got 10 redemptions that actually come onto our platform.
Mm-hmm.
Just
Very
from a
hard.
discount code. I know it's different than a bag stuffer, but we did try it. And again, it was very low redemption, but we tried.
Yeah, and I think in general, it's very hard to get consumers to come back off of the platform and onto first party. But oddly enough, I wonder if consumers focus on value right now, given the economic climate. You see a lot of news about dollar deal kind of stuff coming back. I wonder if just advertising the benefit consistently, as some of the things that Seth's talked about and others might work. We're really at time, and we have a couple of more questions that have come in too, and so I think we're just gonna have to handle those with emails back, and maybe we'll connect people if it's necessary. But I want to thank everyone who joined us today to listen in, and I want to extend a heartfelt thanks to Patrick, Chris, and Seth for sharing everything you have today. Thanks, everybody. This was great.
Thanks, Aaron.
Thank you.
Thanks, everybody.
All right.